Hi. Welcome to another Investor Web video. Today we'll expound the term, cash reserve ratio. The cash reserve ratio, CRR, is an important tool used by central banks to control the flow of money in the economy. It is the amount of funds that a commercial bank is required to keep with the reserve banks as a portion of its total deposits. Banks are not allowed to use this money for any other purpose. The CRR plays an important role in controlling the liquidity in the banking system, thereby allowing the central bank to regulate the flow of credit and money supply in the country. By increasing or decreasing the CRR, the central bank can adjust the amount of funds available to commercial banks, which, in turn, affects the flow of credit to customers and businesses. When the CRR is increased, it means that banks are required to keep more money with the central bank, leaving less money available for lending to customers and businesses. On the other hand, when the CRR is decreased, it means that banks have more money available for lending. The central bank typically adjusts the CRR depending on economic conditions. For more explainer videos, subscribe to Investor Web.